Hey everybody, Marty Missouri here. It's the 16th of September 2023. This is your weekly economic update. Today we're going to focus primarily on the consumer. During the week last week, inflation data came out, but we pretty much touched on that, I think all that we needed to on the midweek market snapshot that was posted on Wednesday. So I just think I'll spend a few minutes today, keep it relatively quick, but point to the consumer and the latest consumer data, sentiment, important reads on what is a very consumption services driven economy. Our general conditions index, we like to call it, you could call it an economic index, the PWA index, that declined once again, negative 25. So you can see it's rolling back over in the wrong direction, suggesting that recession odds, which are plenty already, are actually increasing. It's not a timing tool. I always just kind of qualify it with saying that odds of recession over the next few months exceed the odds of a continued expansion. So we'll see how that plays out. Definitely not a good-looking setup from an economic standpoint in our view. I think actually what I'll do is start with, believe it or not, something a little more positive, and that would be comments that Peter Bookvar featured on his end-of-week summation from Walmart and from JP Morgan CEO Jamie Dimon. From Walmart, their commentary from last week is, in the US, things are better than I would have expected them to be when we started the year. I was concerned about the amount of inflation in categories like dry groceries and consumables. How would that impact discretionary purchases? Had an eye on the consumer balance sheet. All of those things that we were talking about at the beginning of the year. But things have held up better than I would have guessed, and I think better than most of us would have guessed. I think the employment situation, wage increases, some pockets of disinflation are all helping that. So we do see some behavioral change for some customers that are particularly pressured from a budget point of view. There's lots of other retailer commentary. A lot of it is negative that I could point to, but there's plenty of stuff to point to for this presentation. But by and large, a lot of it is suggesting that they're seeing some behavioral changes that are pretty consistent with late cycle, recession coming types of behaviors. As for JP Morgan's Jamie Dimon, he says, I'll tell you about the consumer. It's pretty good. They have more money than they've had. Home prices have gone up for the last 15 years. Asset prices have gone up. Their balance sheet is in great shape. Their incomes have gone up. They've got more cash in their checking accounts than pre-COVID. It was a lot more, and it's been coming down. We'll talk about that more in a second. So that excess, we call it excess savings, seems to be normalizing. Wages are going up, particularly at the low end. It's pretty good, which is why you have a pretty good economy. But then he takes it back a few bullet points later. And there are big buts here. And I just think people are making a mistake to look at real-time numbers and not look at the future, which is, of course, what we always are trying to do here. And the future has quantitative tightening. That's the Fed basically sucking $94 billion a month of liquidity back out of the system. We've been spending money like drunken sailors around the world. Put an exclamation point on that one. This war in Ukraine is still going on. Those are really big buts. And to say the consumer is strong today, meaning you're in kind of a booming environment for years, is a huge mistake. And obviously we agree as we continue to give you our overall assessment of the go forward outlook. Okay, so I will bring that back here in a second. And this chart, or charts that basically say this, are really making the rounds. The bears in particular are throwing this one up, and that is that credit card debt in the US is now for the first time above the 1 trillion mark. You can see where it was when the consumer was way out over his and her skis back here during the great financial crisis. They got even above there right before the COVID recession and so forth. But it's all about context and perspective. I don't want to downplay that, but I'm kind of going to a little bit. The ratio of consumer debt to disposable income says that while that total credit card number has been going up, income has actually been going up more so than the debt, right? On a trend basis. Of course, that wasn't the case here, but rolling back over here. Also, we should look at total consumer debt relative to the size of the economy. So consumer debt relative to GDP, as you can see, is dramatically lower than it was during the financial crisis, and it's come off the boil quite a bit here post-COVID. Total revolving debt, though, is continuing to go up. So again, $1 trillion of that is credit cards. Total consumer debt year-over-year change. So the year-over-year increase in consumer debt has come down a little bit, still 5%. I'm not saying that's low, and I'm not saying that consumers aren't continuing to add to their debt. They indeed are, right? Just at a pace a bit slower would suggest maybe a come down off of all that phenomenal consumer spending. And then total consumer debt monthly change, $10 billion increase, right? That's what that 4.9% amounts to. Again, a lot of an increase, but you can see the consumers were just racking it up right in here as well, and now they're coming down off of that. But still, historically, it's plenty. So the question is, will consumers keep that up, and what are they spending all that new debt on? So again, moral of the story there, is that yes, this is something to pay very close attention to. It's had quite the spike of late. But when you look at it from an overall consumer balance sheet perspective, it's not as bad as that chart all by itself, or as some people might portend. And again, folks, that we're not bullish right here, but we want to paint the real picture. We don't want to just show you stuff that confirms our thesis. Consumer confidence has been slowing back down. We had a nice trend increase, beginning to roll over a little bit right here. The latest University of Michigan's survey came out this last week. It fell, as I showed you on the chart here, 2 points to 67.7, 1.3 points under expectations, with all the decline in the current conditions components, as expectations actually rose a touch after the August drop. 1 year inflation expectations did cool to 3.1% from 3.5, matching the lowest since January 2021. The longer-term guess fell to 2.7 from 3.0. Both were influenced by more people thinking that gas prices will go down, which they are currently not, and instead are rising. So it'll be interesting to see what the next University of Michigan survey says. Expectations for employment over the coming 12 months dropped by 9 points and is back near the recent lows. The income component softened too. Of note was the big drop in spending intentions. I mentioned this the other day, with consumers citing both high prices and interest rates. Those who said it's a good time to buy a home declined by 6 points to a 4-month low. Expectations to buy a vehicle was down 9 points to the lowest since December of 2022. And plans to buy a major appliance dropped 11 points to almost a 4-month low. So folks, again, these aren't signals of a robust, ready to take off economy, to put it mildly. And then let's see, the last one of mine, NFIB, Small Business Survey. As you can see, it continues to be uninspiring. Currently, you can see that the optimism ticked down a little bit last month. Hiring plans were flat, so same score. CapEx, investing in your business plans, rolled over a bit here, all in pretty serious downtrends, all at levels you tend to see around recessions. Again, from Mr. Bookvar, NFIB small business optimism for August slipped to 91.3. The internals were pretty mixed. Bill Dunkelberg, he's their chief economist, said, with small business owners, views about future sales growth and business conditions were discouraging. Owners want to hire and make money now from strong consumer spending. Inflation and the workers' shortage continues to be the biggest obstacles for Main Street. So again, this is going to be very interesting to watch when you look at some of these consumer data that I'm going to show you more of right here. Borrowing from a few sources, This chart right here comes from BCA. Let me make that a little smaller. Average interest rate for investment grade, high quality corporate bonds, auto and personal loans, and 30-year conventional mortgage rates are at 2-decade highs. It's got to be constraining, I would say, for the economy. Now, having said that, though, I do want to make the point that to the extent that corporations were able to refinance around those crazy low interest rates in COVID, we're 3 years removed from that now. So at some point, and I'm sure some of that's happening, you're going to have to see some of that debt refinance at much, much higher rates, let alone what the government's faced with, because they did a ton of short-term borrowing. Housing market developments clearly point to tight monetary policy. So basically, the point the analyst is making here is that conditions are tight and ultimately going to be very constraining, if not already, for the economy. So what they're showing here is single-family home sales in the solid line here. New home sales, you can see they're going up, and that looks pretty impressive. But of course, that's coming at the expense of existing sales. And it's all about people having low interest rates. They may want to sell, but giving up a 3% mortgage and grabbing a 7.5% mortgage ain't going to happen. So there's just not any inventory of existing homes. It's all in the new home space. And by the way, I talked about this a week or two ago. The latest home builder sentiment index was on the borderline of recession. So home builders aren't feeling what this line might otherwise portend. And then from that sentiment survey, University of Michigan, I said bad time to buy a home is at like 40-year highs, right? And then why is it a bad time to buy a home? Well, a year or two ago, it was because prices are so high. You can see that's not as much a reason now as higher interest rates are. So that excess savings that arguably was biggest in the U.S. and had a lot to do with why the U.S. continued to look in better shape. Jamie Dimon talked about that as I read to you. Where's that going, right? So 3 ways of looking at it or estimating it would be the level of savings in banks, level of income and expenditures for consumers, and then the savings rate itself. Based on the savings rate itself and how that would bleed into existing savings, June of next year, so summer of next year, would be when the excess savings, COVID savings, if you will, are gone and are no longer there to support the economy. In terms of level of income and expenditures, it's somewhere in between there and right now, right, based on the level of saving, or the end of this month, September 2023. So it's clearly it's somewhere in between. The question is, when that's gone, and you're looking at what people are doing now with their credit cards, and by the way, delinquency rates, I'm going to show you a little bit of that right now, are going up at kind of an alarming pace. And then in 2 weeks, folks are going to have to start making their student loan payments again. And I know from folks I talk to who are in that situation, it's a real hit to their budget in many, many instances. And make no mistake, that's going to be felt in the economy. Labor demand is cooling rapidly, also from BCA, which will soon result in rising unemployment. So they make the case there. Job openings have been rolling over. There's still a ton of them, but they have been rolling over. Then the relationship here with unemployment and job openings. So the expectation is that'll push unemployment higher. The quits rate, right, that's dropping. Folks quit at a high rate when the economy is really good because they get better jobs. That's falling off a cliff. That relationship to unemployment, that keeps going. Unemployment's going to go up. And then from Hedgeye, let me just get that a little bigger again. They're obviously pulling from that small business survey from the details. NFIB small business sales, you can see quite the decline here. And then compensation plans going up. So here you've got something that bleeds through to higher prices to the extent that people will still pay those higher prices. And although here you have sales sentiment really declining, so the term stagflation comes to mind, stagnant economy while having inflation. And then talking to, in fact, this last week, 2 different clients. One had basically told me that that they're really sympathetic to our view that recession odds are high, and they think it's here already, and they're seeing it when they're out and about and talking to their friends. The other client says, I hear what you're saying, but when you look at travel and people spending money on concerts and restaurants and so forth, sure doesn't look like the economy is rolling over. And I sympathize with both because we look at such a large cross-section of data. And ultimately, things do peak, right? Ultimately, things like spending, vacations, that sort of thing, that activity peaks. And my view is that maybe what we're viewing right now in certain areas is that last big thrust, that last big peak before things begin to roll over. And then Hedgeye does a lot of really good work. And here is, trends that have to do, in this case, with casual dining, right? Weekly traffic changes, and you can see these are negatives. Nationwide monthly year-over-year traffic change. So again, the data is beginning to suggest that discretionary action is beginning to roll over. Quick service restaurants, QSR, really rolling over. Apparently McDonald's business is really beginning to wane. So again, signals, signs that the consumer is getting a little stretched or maybe a little less likely to get out there and spend. Casual dining monthly. You can see as we've gotten into 2023, same-store sales were actually positive while traffic was down. So how is that possible? Well, obviously it's inflation, right? This is reflecting higher prices, right, that have exceeded the less traffic, meaning enough people have been willing to pay those higher prices so that these stores were seeing positive same-store sales, right? However, the actual traffic is down. And then notice that this is the second lowest same-store sales percentage of the year was in August. So not rosy trends. And then more of that data on a weekly basis. And then more of it on a quarterly basis. Again, traffic trends going down. Same-store sales quarterly, still positive, but just barely. Traffic really rolling over. And then just a couple of snips from Hedgeye's Director of Research, Daryl Jones, in one of his commentaries this last week. Credit card balances, we talked about that. That's what I'm talking about. I mean, they make a really big deal out of that. And, again, I appreciate that, but I think it's important to look at it in the context that we did starting out. Credit card applications and limit increase rejections along with auto loan rejections have skyrocketed. Excessive debt, limited discretionary income, and rapidly tightening credit, meaning credit standards, tougher to get loans, could significantly impact GDP. Almost goes without saying, right? And then cites from the latest report from the New York Federal Reserve Bank. The overall rejection rate for credit card applications has climbed to 21.8%, the highest since June of 2018. The rejection rate for auto loans went from 9.1% in February to 14.2% today. Credit card limit increases, rejections have increased 30.7%. So the fact that these numbers are what they are, and sentiment is what it is, and valuations are what they are, and student loan debt is about to come back on, and it has been the consumer that's held up this economy, we think that if indeed that blizzard's going to hit the mountain, and that would be the recession, it's probably going to come sooner than later. Of the economists who we pay for their deep research, one firm says it's the fourth quarter. Another analyst in another firm thinks it's a first half phenomenon. The most bullish analyst in that same firm, happens to be BCA, says it's a second half of 2024 affair. So even the bulls are suggesting there's just probably no way out of this without recession. And investment clients, what that means is that until either that recession hits and the valuations on the things that we really want to own during the next bull market get to levels that are attractive to us, or the overall environment improves to the point where we don't need that hard landing, but our data and our way of looking at the world says it's safe to start climbing that mountain then. Happy to do it then as well. Right now, this is a time for patience and to make money where you can. Expect to suffer a drawdown if that blizzard hits, but be hedged, be diversified, don't have all your money in the market by any stretch of the imagination, and be ready to take advantage of either conditions when they improve and or valuations when they get really compelling. For us, that means those valuations are consistent with current conditions as we see them, which is not the case as I talk at you here today. Thank you, as always, for watching and listening. I hope you have a great weekend. Talk to you next week. Bye-bye.